All right, welcome everyone tonight to the Ninja Wealth Exchange, episode 6. So tonight's topic is how to pay less taxes and build more wealth. And tonight we've got a special guest speaker, Cindy Pham from Houston, Texas. She is a 1031 exchange specialist. And, at our podcast here, we're here to share with you the secrets of wealth building. So myself, Lore, and Johnny, co-host over here, we're here to teach you guys a little bit about a strategy that a lot of real estate investors use to scale and build their wealth faster. Um, Completely legal. You don't have to pay as much taxes, and you can go bigger and faster, quicker. So let's bring in Cindy here. Cindy, do you want to introduce yourself? A little bio about yourself?
Hi, thanks for having me. I'm Cindy Pham. I'm with Legal 1031 Exchange Services. We are a qualified intermediary and we facilitate the 1031 exchanges.
Awesome. So there's so much stuff to talk about here, right? 1031 exchange, it can be very complicated. So we'll try to keep it pretty much high level at this point. If you guys do have more additional in-depth details about your personal situation, we'll give you Cindy's contact at the end, and you definitely should reach out to Cindy. So I think you've been doing this for 7 years, correct?
Yes,
So
7 years. Part of that, so by the way, my background is in real estate. I was in commercial real estate.
Mhm.
Part of that, I do have a CCIM designation, so I don't have a tax background. I'm not an attorney, so I don't give tax. A lot of people like to ask me about tax advice. I don't give. I know enough to be dangerous, but I'm not allowed to give tax advice.
Very true. We know how that goes, right? As real estate agents and loan officers, we have to defer our specialties, right, to the person who's an expert there. So just starting off, what is a 1031, Cindy? How what exactly is that?
So the 1031 exchange, this is a tax code. Tax code. It's an Internal Revenue Code, Section 1031. So this is a tax code that allows an investor to defer capital gain taxes when you are selling one investment property and you're trading it, exchanging for a different investment property. Okay, so essentially you're trading it. So let's say if you sold a $500,000 property, you're trading it for a different $500,000 property or more for a full tax deferral. In order to do a 1031 exchange, you have to use a qualified intermediary to facilitate the exchange, which on a what we call a forward exchange or delayed exchange, the intermediary is holding the funds in between you selling the property and buying the next. Now, this is a federal tax code, so property can be anywhere in the United States. So it doesn't have to be in the same state. It could go from California to Texas, New York to Florida, anywhere in the United States.
All right, cool. So some important things real quick. You said it defers taxes, right? Does not eliminate them.
Correct. Correct. It's a tax deferral. Um, how I explain this is that with the tax code, and I'm going into CPAs like to call this a like kind exchange. So if you hear a like kind exchange or a 1031 exchange, it's the same thing. But a like kind exchange where you're trading a property of a like kind, it's an investment, property held for investment or a property of a trade or a business. So that means to our government, to our IRS, our property, our investment property contributes to our economy. Okay, it generates business. Now, if you sell your property and keep the funds, they're gonna tax you. They recognize that you have gains. Okay, so they're gonna tax you on your capital gains. But instead of selling that property and pocketing the funds, you reinvest into a different investment property. This recontributes the proceeds into our economy again. So it's not just the real estate agent, the lender, the appraiser, the contractor, the subcontractor, the laborers. It goes down to your retail, kind of like your Lowe's and your Home Depot. So this actually generates, this contributes to our economy. It generates more jobs for our economy. So therefore, the IRS says, well, if you sold this property and you reinvested and all those proceeds went into recontributing to your economy, we will not recognize that you made a gain. So this is a non-recognition treatment tax code. But let's say you sold a property for 500,000, and then you ended up buying a property that was you didn't want to put the full 500 into the next property. You want to keep some funds. Let's say I chose to keep 50,000 just so I can, buy a car for my child or pay off other debt. Well, anything you keep, they will recognize that as the gain, right? Or let's say you just found another property that was 450 and you bought the property that was 450 and there was some funds left over. Well, you end up keeping those funds. Well, they're going to recognize that as the gain. So whatever you don't reinvest into the next property, is you get taxed on the difference. So it's a partial tax deferral versus a full tax deferral.
All right. So makes sense. Basically, you're trying to keep as much of your profits from being taxed so you can use it to the next investment property, right?
Correct. And you can go, it's a tax deferral. So you can go from one property to property A and you 1031 exchange it to property B. After you held property B for a while, you 1031 exchange it to property C. And you can keep on deferring forever, right? Kicking the can down the road forever and ever. You can potentially swap until you drop.
Okay.
Right?
So
when you
basically,
pass away, when you pass away, all the taxes kind of go away. And then your heirs get a step up in basis. So they're not paying the tax. You're not paying the taxes in your lifetime. Your heirs not paying the taxes during your lifetime either, because you pass on and they've inherited the property.
wow, that's very powerful, especially if you're trying to build your generational wealth, right?
Correct. It's strategic. The 1031 exchange, it's amazing because it's very strategic for building that generational wealth.
All right. So how does one do a 1031 exchange? What's the process?
So you've got to have a property under contract. So you're selling an investment property, and so once you're under contract, that's when the intermediary gets involved, the qualified intermediary. So I get involved, and then I set up the 1031 exchange. We have exchange documents for the clients, and then we work directly with the title and escrow or the closer for the property. So the funds need to be wired to the qualified intermediary. Now, it's important because once we close on this property, there is a timeline for you to complete your 1031 exchange. You'll have 45 days to identify or designate what you potentially want to buy, and up to 180 days to close on the identified property. And so once we're holding the funds, you identify, which will provide forms for you, but you'll identify what properties you want to select, list them, send it back to us. That's considered identified. Once you know what properties that you want to buy, I need that contract so I can direct the funds towards the purchase, and then it closes out your exchange.
Got it. Okay. So quick question. Can you only buy the properties you identify in those 45 days?
Correct. They have to be, to defer the taxes, it has to be a property that you identified.
Oh, got it. Okay. So 45 days to identify, and there's a unlimited number of identified properties, or is there a limit?
There's multiple rules for identifying. There's 3 rules to identify, and you use one of the 3 rules, but the most common rule to identify is the 3 property rule. So you can list up to 3 properties on the identification form. So all we care about is just the address of the properties. It has to be specific properties. You can't just say, I'm going to identify a house or a piece of land, right? It's got to be a specific property or a legal description. So you can list 3 properties. We don't even care about the price. Okay, so that's the 3 property rule. There's another rule called the 200% rule. That rule means you can identify as many properties as you want. So that's 4 properties or more. But however, the aggregate value of everything you identified cannot be more than 200% of the sales price of what you just sold, your relinquished property. So let's say if I sold, if I sold a property that was 500,000, I can identify 4 more properties, but the aggregate value cannot be more than $1 million. It can't be more than double your sales price. And then the third rule is not used very often. It's the 95% exception rule. So you buy 95% of the number of properties that you identify. That rule essentially, it just means you buy everything you identified. If you identify 4 properties, that you cannot use the 3 property rule, that doesn't work. So if the 4 properties is more than double your sales price, you can't use the 200% rule. So that the last rule kicks in. So you have to buy 95% of the number of properties you identified. So if you buy 2 out of 4, that's 50%. 3 out of 4, that's 75%. So essentially, you got to buy all 4 properties. So it's 100%. So that last rule essentially means you buy everything you identify. But that one's not used very often. Most people are going to use the 3 property rule.
Okay. So now I understand why they give you 180 days in case you do have to buy multiple properties, right?
Yeah. So like, let's say you're going to sell. And by the way, when I mentioned like kind property, it's a broad term, right? It's a property of investment or for a trade or business. So it could be land. Land is held for appreciation. It could be if it's a house, it needs to be a rental. Okay, it cannot be your home that you're living in. It could be commercial, industrial, retail, office building, any of that. Oil and gas, mineral rights, those are considered. There's a couple of creative like kind properties, but you don't have to go from land to land, house to house, commercial to commercial. It could go from, let's say I have a piece of land, I'm going to sell 1 piece of land, and then I'm going to buy 3 rent houses, right? Single family home rentals. And then after I held that for a while, I'm going to sell all 3 to buy a multifamily apartment unit, or go to like a commercial building. So you can cross types of assets. It doesn't need to go from one to another.
Okay. So I have a quick question. So you talked about rule number 2, right? I'm just trying to understand it a little bit better. For rule number 2, where it says you can only go up to double, does that mean that let's say you sold it, you got $500,000 in gains, right?
Mm-hmm.
And you're saying you can only
let's say, how much did you sell the property for?
So let's say you sold the property for 500, right?
Okay.
And it could be $300,000 in gains, right? When you list the properties out that you want to purchase, it has to be either 3 or it has to be underneath the $1 million mark. Does that mean are you saying that when you're looking at properties, let's say you're deciding between a $800,000 house or not house, but $800,000 real estate property that you're looking to pick up, or a I don't know, the second would be another $600,000 property that you want to pick up, that's over $1 million already. Can you not identify another one?
So
you run out of options?
if in that instance you're going to use the 3 property rule, and the price point doesn't matter, we just need 3 properties.
I see. So then you're limited to, like, you actually have to.
There's no limitation on the value of the property if you use the 3 property rule. So it's only if you identify 4 properties or more, right? Then the value kicks in. If you identify 4 or 5 properties, then those 4 or 5 properties cannot be more than $1 million. It can't be more than 200%. That the aggregate value of the 4 or 5 properties cannot be more than double your sales price, 200% of the sales price of what you just sold. Right.
So you really have to know what you're going to be looking at before you even go into the 1031 exchange process, right?
You want to have good intentions of listing that. The 200% rule actually works better for a higher price point property. So let's say I sold a property, a commercial building for $3 million. I don't want to be limited to just 3 properties. So I'm going to use the 200% rule. So I want to list out 4 properties, and the 4 properties cannot be more than $6 million. So it works better on a higher price point property where you don't want to be limited to 3 properties. And I've done exchanges where some properties are 10 million, 15 million. You don't want to be listed. You don't want to be limited to the 3 property rule. So you sold for 10 million. Well, you're going to use a 200% rule where I can identify up to $20 million worth of property.
Got it. Yeah. So the reason I'm asking is because I've had people come to me and said, hey, so my intermediary said that we can just go ahead and get a whole list on the MLS, right? And we're just going to go ahead and there's like 20 different properties. We don't intend on buying all the properties, but one of these we will purchase. So that's actually not true then, if that's the case.
Well, no, that is absolutely not true. So that is absolutely not true. So therefore, you know, when you're looking at a qualified intermediary, you really want to work with a company that knows what they're doing. And with the
Absolutely.
qualified, and I always talk about how to choose a qualified intermediary. You want to make sure that they are knowledgeable, they know what they're doing, and because with the qualified intermediary, and also the security of the funds too, right? Because you cannot hold the funds, right? So who's holding your funds, and what are they doing with your money? And with
So
the,
true.
yeah, with this industry, anyone can be a qualified intermediary, right? So you want to look at a intermediary that is well funded, they have a strong financial background. My parent company is worth 15 billion. We're insured. We've been doing this for 30 more than 30 years, and we know what we're doing. But you know, it could be just Joe down the street that's an attorney that goes, well, I'm just going to be a qualified intermediary and, you know, service this for my client as well. However, they just gave you the wrong information right there. They're not, they really don't understand how to do a complex deal. And even the simple part of identifying a property, they said that, oh, they just list 20 properties. Well, you know, that doesn't work. That's
Good
a
to know. Good to
major
know.
disqualification of your 1031 exchange. Yeah.
All right.
Yeah, so get an expert, guys. You know, call
Yeah.
Cindy.
Yeah, no, you know, I get very sensitive about that because you're going to use a qualified intermediary that doesn't know what they're doing, and then that deal gets, or they did something shady, like because these are rules. By the way, I'm just the messenger. These are actually these guidelines are from the Treasury regulation. This is the law. This is the IRS. This is tax code under the Treasury regulations. I don't make up these rules, and if the rules are 45 days to identify them, 180 days to close, and an intermediary says, well, I have a way to go around that. There's no flexibility on these. Are hard calendar days unless it's a federally declared disaster. Now, if an intermediary says, hey, I can be flexible on those dates, well, that means they're doing something it's fraud, right? It's illegal. If this file gets caught, it gets disqualified, and guess what? This intermediary, this small intermediary that doesn't really know what they're doing, that's being flexible, well, they're going to go through all of their exchange files and audit every single one. And then even if your exchange was good, well, it's going to get audited too because this intermediary was kind of shady. So those things you want to kind of be careful about.
Yeah, and that if that's the case, you could end up having to pay taxes on all of your gains.
Yeah.
Right?
Well, let's say if you didn't, your exchange was not valid, or you did something shady. Well, guess what? You end up paying your taxes. There's penalties, and this is technically tax fraud. It's a felony, right? So the penalties for a felony. Then you're on the IRS naughty list, the red flag list, and that's a list that you don't want to be on. I always say Santa's naughty list. Santa forgives you, but the IRS does not. You're on that list for a long time.
All right.
Yeah.
Good to know. Good to know.
So can you talk about some of the more common mistakes that investors make when they're trying to do a 1031?
The biggest mistakes is that they call me after they've closed.
Yes.
They call me today. I realize that I have so much taxes that I have to pay. I'm like, well, when do you close? I closed last week, or I closed yesterday. So remember, we have to be involved before you close to receive the funds. Because our exchange documents actually assigns this contract over to us as the intermediary. It gives us the right to receive the funds. So and this can be done, a 1031 exchange can be set up very last minute, pretty close. So like I'll get the calls, hey Cindy, I'm on the way to closing. I totally forgot to set this up. So it's like, well, you better hang up right now, call the escrow company, tell them it's a 1031 exchange, get your computer and email me the contract right away so I can set this up before you close. But that's just, I always tell people, do it early. Once you're under contract, you can set this up. You don't have to put the real estate agent, the lender, the escrow officer, and then you're under stress too. But it's always good to set it up early. Then it could be done last minute. That stresses everyone. If you set up a 1031 exchange and it doesn't go through, we just cancel the file. Nothing happens. You just close as normal, or you don't close. You just close as a normal sale. But if you just decide, hey, I'm not sure if I want to proceed with a 1031 exchange, it's better just to set it up and then just let me know if you don't want to do it, and we just cancel the file, and then you just close as normal.
Got it. So the trigger event that starts the countdown, what is that? The closing?
Correct. The
Okay.
closing set starts the timeline.
Okay.
And you can do multiple properties too. I think you mentioned earlier you had a client that sold a property and bought 3 houses or so, or 4 houses.
Yes.
Right? Yeah. And so you can sell like multiple properties. Let's say in the future they want to sell 4 houses and buy like a multifamily or an office building. Well, the timeline will start at the close of the first sale. So you're going you close on one property. You're going to want to get property 2, 3, and 4 to close, so I can receive the funds to use the funds to buy the commercial property. So it gets more strategic and tricky. You've got to really work those deals. You want to extend that timeline for closing, and you want to get those other properties sold. But it can be done with multiple properties.
Okay. What happens if you do fail in the middle of a 1031, right? You don't identify or you can't close.
Yeah. So you've got 45 days to identify what you want to buy. So if you're at the 44th or 45th day and you realize, you know what, these properties I identified, I'm not going to be able to buy, you can always revoke those properties and change out the properties and identify different properties. So you're within the 45-day timeline, okay? But let's say if you just can't find any properties at all, you can just revoke all of that and have nothing identified. So the intermediary can release the funds on day 46 and you just pay your taxes. Because if there's nothing identified, then there's no exchange. So the funds can be released to the taxpayer on day 46. Now, let's say you left properties identified, or you changed out day 45, another set of properties, and then day 60 comes along. And you said, hey, Cindy, we looked at these properties. They got bought from someone else. Inspections didn't come out good. We just can't buy these properties. Well, because they're entitled, they're identified, you're entitled 180 days to close on an identified property. So therefore, even though you're not going to buy these properties, they are identified properties. So we cannot release the funds until day 181. Because we have to give you the full 180 days, the opportunity to close on an identified property. So worst case scenario, you get your funds back. If you don't if you have a failed exchange, you don't complete your 1031 exchange. Worst case scenario, the intermediary can give you back the funds on day 181, and then you pay your taxes. But there's no penalty for not completing your 1031 exchange. If you can't complete your 1031 exchange, the IRS is probably happy because they get tax dollars.
Right. You just got to pay your gains, right?
Yeah.
The taxes and gains. And then you'd still have to pay you though, right?
Yeah. So we charge depending on where you're at. Sometimes it's $1,250 or $1,500. That's a common fee, $1,250, $1,500, depending on where you're at. And that's a flat fee, and it doesn't matter how much the property is.
Okay. Good to know.
And that's actually really good. I've seen people charge a lot more than that. So that's really good.
Well, that's what we charge, but
very fair. Yeah,
but it's with my competitors, that's about where it's at. In the Northeast, New York, New Jersey, the fees are a little bit different. It's scaled depending on the price of the property, but they close a little bit different. They use closing attorneys. That's required over there. So their structure is a little bit different, but it's generally about $1,500.
Okay.
Right.
So now we talked about how it works and the rules and process, things like that. Let's get into some scenarios here, right? So something make clear that we didn't make clear in the beginning is that you can only 1031 an investment property. It can't be your primary home, right?
Correct.
Some sellers have come up to us as agents. Hey, I'm trying to sell my house and I want to pay taxes. Can I do a 1031? Do you live in it? If it's your primary, then no, right?
No, but then the thing is that if you are living in your home for at least 2 years, you have a
Correct.
homeowner's exemption.
Mhm.
250,000 if you are single, or 500,000 if you're married. Now, if you lived in your home for like 30, 40 years and you pass that exemption amount, you just gotta bite the bullet and pay the taxes on the difference, unless you move out of it and you lease it.
Right.
And then let's say now you lease it for a couple of years. Now you can use a combination of a 1031 exchange
Mhm.
and this tax code is called the 121. It's the homeowner's exemption. So it'll be a pro rata share. So let's say I lived in it for, let's say it's a property that I've owned for 5 years. I lived in it for 2 years and I leased it out for 3 years. So 3/5 of it would be a 1031 exchange and 2/5 of it would be a homeowner's exemption. Pro rata share.
Okay.
That's so
Yeah.
interesting. Okay.
All right. So now when you're 1031ing into your investment property, you're going to 1031 it. Can you do that into a second home or vacation home?
So technically, it's got to be an investment property. There is an exception to vacation homes,
Mhm.
and it's through Revenue Procedure 2008-16, I believe. But so there's a rules to it. So if you do a 1031 exchange into a vacation home, the requirements is just remember 2, 2, and 2. You've got to own the property for 2 years, and you have to lease it out for at least 2 weeks a year. And limit your personal use to 2 weeks a year. And then after the 2 years, you don't have to fulfill that requirement anymore. You can use it as much as you want, change the intent into your homestead, your retirement home, but you want to limit your personal use and lease it out for at least 2 weeks a year. Now, if it's a home that you truly your vacation home that you've never leased out, that's considered a second home. Second homes don't qualify. Okay, if it's a second home that you never lease out, it's all just pure enjoyment. You never lease out in your life. It's only for friends and family for free. That's a second home, and that doesn't qualify. Okay, it has to be a vacation home with the 2 weeks of leasing it out. And by the way, if it's a second home that you do have and you have an exit strategy, you want to, last 2 years of owning it, you want to do the same. You want to lease it out for 2 weeks a year and limit your personal use to 2 weeks a year.
That's good to know. So if you do have a vacation home, you are putting it on Airbnb, whatever, right? When you sell that, you could 1031 it. Is that what you're saying?
Okay. And Airbnbs, there's still investment properties because most Airbnbs, you're marketing it throughout the whole year. You're trying to lease it out the whole year, right? So they're short-term investment properties, but they're still investment properties. So that's not an issue. These are more of like your true second homes. I get a lot of clients. I get a lot of clients that, let's say you have a child going to college and you don't believe in paying rent. So you're going to buy a condo or buy a home for your child to live in. Or let's say I have an elderly parent and, I have a home. I bought a home for my parents to live in. Well, if they're not paying you rent, it's considered a second home.
And so charge your parents rent, right?
Yeah.
Charge your parents rent, okay, or your child too if they're going to college.
Yeah, your child too.
Charge their roommates. So same thing then, I guess. Along the same lines, similar lines here. Can you 1031 into a house hack where you buy a duplex multifamily where you live in one unit and you rent out the other? Can you do that?
Yeah, that's a split treatment. So what you're going to do, remember the homeowner's exclusion property. So you're going to basically, let's say you have a fourplex and you're going to live in one unit. So you're going to take the value of 2, 3, and 4 unit 2, 3, and 4 and exchange it only into that value of that 2, 3, and 4. So you're going to exclude the unit that you live in is probably a nicer unit, but you're going to exclude that from the exchange.
Wow. Okay.
So I did that recently too. So I had a client, he had a fourplex and he lived in one of the units. So he gets his unit, he gets a homeowner's exclusion from his unit. He was a single man. So his gain, he's exempt up to 250,000. So the value that he exchanged was, you allocate what's the value of unit 2, 3, and 4 together, and then you did an exchange, and you got a split treatment right there, and he has an exemption on his part of that unit. I'm in Texas, so I get a lot of farm and ranch people too, and they have a home, right? Let's say they have 10, 15 acres, and they have a home that they live in, so they'll parcel out a part of it and do a split treatment, so they have the homeowner's exemption on, the area that the house that they live in, and then they'll 1031 exchange on the land part.
Really? Wow, that's interesting. Okay.
Very cool. I think that's awesome.
So then how about, can you combine 1031 into an investment property, and then can you still do that cost seg and bonus depreciation as well? Can you do all that?
Yeah. So there's 4 levels of taxes. Okay. When you sell a property, you've got 4 levels of taxes. There's the depreciation recapture tax, which is 25% of what you depreciated. And then your capital gains tax is going to be 15 or 20% depending on your income bracket. And then there's the net investment income tax, which is 3.8. The net investment income tax, some people call it the Medicare surcharge or the Obamacare tax. It came during the Obama administration. We still have it today. And then there's the state taxes. So there's 4 levels of taxes. So when you're doing cost segregation, bonus depreciation, any type of depreciation on the property, it doesn't matter because it's a write-off during the time that you own it. But at the very end, when you're selling the property, you're getting taxed back at 25% of what you depreciated.
Right. And then to avoid that, you could 1031, right?
Correct. Right. If, I love this industry. I always explain this because it's so strategic, right? So let's say, I've got a property in California. Let's say it's all cash, all gain. Let's say it's $1 million.
Mm-hmm.
And with the depreciation recapture tax, it's 25%. I'm on the highest tax bracket. That's 20%. Plus another 3.8% for the net investment income tax. And then you've got the state taxes. Let's say conservatively, I'm going to be taxed 35%. Conservatively, right? So now $350,000 is taxed. I net out $650,000. I'm going to reinvest $650,000 in a property in Texas, or I can reinvest $1 million property in Texas. So you got to look at the why you want to do a 1031 exchange, because 1, no one wants to pay taxes. Who wants to pay all that in taxes? 2, you've got more purchasing power. Now I could buy $1 million property versus $650,000. That's a big difference in an asset, right?
Absolutely.
And you look at the return on investment. I have a better return on investment on a higher price point property than I do on a lower price point property. Now you guys are also lenders too, right? You do loans. Let's say this is all cash. Let's say I'm going to grow my real estate empire. I'm going to leverage this, right? I'm going to do a 75% loan to value on $650,000. My buying power times 4 is $2.6 million. But if I had $1 million and I leveraged that, then my buying power is $4 million. So now if I leverage this, I can either buy a $2.6 million property or a $4 million property. It's a big difference. Got more purchasing power, better return on your investment, right? I mean, you can, it's hard, but by doing a 1031 exchange, it's just strategically, it's just a better strategy for growing your real estate, right? But also people do this for estate planning as well. We kind of mentioned it earlier. Because I always joke around, I said a 1031 exchange, it follows you, You sell property A, you 1031 exchange to property B, you 1031 exchange to property C, you keep going, right? If you sold the property, if I sold A, Uncle Sam wants my tax dollars. I go, no, I'm going to sell and do a 1031 exchange to property B. When I sold property B, Uncle Sam's right behind me. He's stalking me. Right? He wants tax dollars for B and A. And I go, no, Uncle Sam, I'm going to 1031 exchange to property C. Okay. Uncle Sam here is a stalker. He's in love with me. He's following me from property to property to property, right? But at property C, let's say I bought it for 500,000. Now I died, it's worth $1 million, right? Uncle Sam, who was in love with me, following me from property to property to property. Well, when I died, he was so sad he goes away, right? He's not in love with my child. My child inherited my last property C at $1 million. So I bought it for 500. It's now worth $1 million. I died. My daughter inherited the property at $1 million, right? So the tax dollars for the gains for property A, B, and C, it's all gone, right? It goes away once I die. My daughter inherits the property. She gets a step up in basis at property C at $1 million. So she basically, her gain starts at $1 million, and she earns her own Uncle Sam stalker. But it's a step up in basis, right? So it's building the generational wealth. A lot of people do it strategically for that as well.
Right.
Yeah, I feel like you have to have a whole team to really dedicate to all that stuff. And once you get a 1031 exchange, you want one that has some longevity, so that as you're doing the business and you're growing your portfolio, you can always go back to that person to make sure they have all the documentations and that it moves really, really smoothly from one step to another. Would that be true?
I mean, we facilitate the 1031 exchange, but really the tax burden is always on the taxpayer, right? So
Okay.
I'm here to kind of help guide you with the guidelines and the process, but you really, like each person, you really want to have a good CPA,
Right.
right? And CPAs, there's good CPAs out there. It's like doctors. You got good doctors and you got heart surgeons and you got a foot doctor. You don't want to go to a foot doctor for a heart issue, right?
So true. Yeah, so true.
So I always recommend have a good CPA. At the end of the day, I cannot tell you whether you should do a 1031 exchange or not. It's really your tax advisor says, do you recommend? Because then again, you've got all this gain here, but your CPA may say, hey, you know what? You have other businesses and you have other losses that will carry forward, that will offset your gain. So in a sense, even though you have a gain on this property, you may not even need a 1031 exchange because CPA has other write-offs for you, right? So you always want to talk to your CPA.
Yeah. So essentially, you have to build a good team all around you, right?
Yeah, you do have to have a good real estate agent,
Right.
a broker,
Loan officer,
real estate professional, your loan officer. Have a good CPA, have a good attorney, and have a good 1031 exchange.
There you go. Right. Exactly. Right. Okay. One of the more so I've heard of a reverse 1031. I've been kind of interested. How does that work?
So a reverse 1031 exchange is when you found the replacement property first, the new property first. So you found a prop that you just gotta buy. It's such a good deal, but it's such a good deal, they're not going to wait for you to sell what you already have, your relinquished property. Okay. So you have to buy the replacement property first. And from the time you buy the replacement property first, you have 180 days to sell your relinquished property. Now it's a more complicated exchange. On what we were talking about earlier is a forward exchange, or it's called a delayed exchange, a forward exchange. You delay the purchase, right? You sell to buy, so the purchase delayed. A reverse, let's say Johnny found a property that he wants to buy. He buys it, okay, and now he just owns 2 properties. That's not an exchange. Okay, so reverse exchange to structure, it's a little bit more complicated because now instead of me being a qualified intermediary, I am a qualified accommodator of title. So now actually my company creates an LLC. We use our LLC to buy the replacement property. So we hold title. Instead of me holding money, your fund, the exchange proceeds, I'm going to hold the title to it. So we create an LLC, we hold title to the property. So you've got to have the exchange, you've got to have the money, the funds, or if you've got a lender, you've got to have all that lined up. So we're not using our money to buy the property, we're just facilitating the exchange. But we create an LLC, we buy the replacement property. And then from the time we close on the replacement property, you have to 45 days to identify what you're going to sell and 180 days to close on what you're selling. Easy if it's more easier if it's a cash deal. And I know you guys do loans too, but if you do, let's say if it's a loan, there needs to be a lender involved. Well, it has to be a non-recourse loan to us, because we're actually facilitating that exchange just for you guys. We're not taking the liability. So the LLC that we created, it's got to be on the loan because it's the entity that's buying the property, but it's got to be a non-recourse loan to our entity. And then typically, the taxpayer guarantees that loan. So not all, you have to have a good relationship with the lender that's willing to do a reverse 1031 exchange if there needs to be a lender involved.
Got it. Okay. So non-recourse meaning so that you avoid the due on sale clause, or what are we?
Yeah. So let's say we hold title to the property. It could be up to 6 months, right? 180 days. Well, if you default on the property, we just here's the property, because we're not in the business of owning real estate, right? So you're not going to sue us for the taxpayer defaulting on the loan. We just hand you over the property.
Okay. All right, let's talk about some other more advanced, I guess, or alternative investments that you can replace with, right? Not everybody wants to trade a rental property into another rental property, right? Maybe they're tired of the landlord life, right? They want something a little bit more hands off, right? So I've heard opportunity zones. I think you mentioned already mineral rights, DSTs. I've heard of that.
DSTs. Yeah.
Can you talk about all that stuff? Well,
yeah. So, those are creative like kinds, right? So a DST stands for Delaware Statutory Trust. So now you're buying, and typically these clients that invest into a DST, your clients are winding down. They're not wanting to manage real estate. So a lot of the profile of it, of the client usually is a bit older. So now you're investing to something that's passive, right? And so a property in a DST, it's considered a security. So only specific financial advisors that work with the DST can kind of recommend that. So a lot of real estate people don't, because it's a security, right? But really you're investing in a fractional interest in institutional grade asset. So let's say I sold a couple of homes and I don't want to manage houses anymore. I don't want those calls anymore. Well, I'm going to invest into a DST. Let's say I've seen like Amazon warehouse, right? I've seen a storage facility. I've seen A-class apartment, multifamily. I've seen a lot of different office hospitals that were put into a DST. So it's usually something very stabilized. Like for instance, like a Walmart distribution center or an Amazon, they're very stabilized. What are the chances that they default on their lease, right? So it's usually a very stabilized. So it's a lower risk, lower return, and a lot of like clients that invest in a DST, it's more about preserving the asset. So when they do pass on, their heirs inherit the property and they get the step up in basis, right? But typically a DST, it's passive. You have no, it's illiquid. So let's say you had 500,000, you put it into a DST. Typically they hold it for 5 or 7 years, and then the DST sells the property, and then you can get the funds back to do another 1031 exchange. Unless there's some DSTs that converts to a REIT, like an UPREIT. So that as well, you just own shares, operating units of the trust. So there's different avenues there. But as far as other like kind, I've done oil and gas and mineral rights. I've done wells. I've done water rights, air rights. Those are all considered real property. So anything that's considered real property works. Easements, as long as they're perpetual easements. So there's a lot more things that you can do. With an opportunity zone, it can be an opportunity zone can be a backup to a 1031 exchange. So the opportunity zone, it is the current opportunity zone that ends at the end of December 26th. And then it was a temporary tax code that at the time it started in 2018, where if you're only reinvesting the gain versus the full amount. So let's say you sold for 500,000, but the gain was only 200. Well, on an opportunity zone, you're reinvesting the 200,000 only into an opportunity fund that invests into an opportunity zone. Now, if you held on to the property for 5 years, you get a 10% step-up basis. And if you held it for 7 years, you get a 15% step-up in basis. Now, this is a temporary tax code. This ends next year, right? December 31st of 2026. So, by April 15th, 2027, you pay the taxes. So the step-up in basis, your gain of 200,000, well, you held it for 7 years, you get 15%. So you're paying 85% of the taxes of that gain. So you're still paying the taxes, you just got basically a discount. Now, if you held the investment for 10 years in the opportunity zone property, well, they don't recognize the new gain on the new property. Okay, so all that is kind of ending in 2026. But now with the new, the one big beautiful bill that just came out, they made this tax code permanent. So they're actually going to select new properties in the for the opportunity zone. So the governor of each state will elect certain properties in the state as opportunity zones. So now this is going to take effect January 2027, right? So this summer, the governor is going to start electing new properties to be in the opportunity zone. But the difference now is that they took away the 7-year step up in basis. So if you have gains, you're reinvesting it for 5 years, you get a 10% step up in basis only. And then if you hold it for 10 years, you get they don't recognize the new gain. And then they came out with the opportunity zone for rural land. So I think areas that is less than 50,000 people the population is less than 50,000. There's an opportunity zone for the rural land. And basically if you hold on to the property for 5 years, then instead of the 10% step on basis, you get 30%. So this is the point of the opportunity zone is to regentrify struggling areas and just develop, a bigger economy for smaller areas.
Got it. Okay.
By the way, I'm not a 1031 exchange. Just this disclaimer, I know enough to be dangerous. I'm not a 1031 exchange specialist. So you do need to speak to a CPA or a financial advisor that works with a opportunity fund. There's a lot of funds out there that invest in opportunity zones, but also you can also create your own partnership, your entity, and self-certify as an opportunity fund to invest into an opportunity zone as well.
Wow. Okay. Can you also 1031 into like a syndication, like apartment syndication?
No.
Okay.
No, because a syndication is basically a general partnership, an entity. So we're trading property, so you have to trade real property to real property. Buying into a syndication, you're buying interest of an entity, a partnership. So you can't sell real property by interest of a partnership, because essentially you don't own the real property. You own an interest in an entity, and that syndication owns the property. You don't own the property. So it's got to be real property to real property. Now you can exchange into a tenant in common structure. So let's say, Laura, you, Johnny, and I, we have 1031 exchange. We decide to partner up by the next property. We can take title together on that property. So we're a tenant in common. We're a TIC, tenant in common ownership, joint tenant in common for the next property. We can own it together. If the syndication is small, where they're willing to allow you to take title to it as a tenant in common, then that might work. But I don't. If the syndication is so big, I don't see that often. But if it's a syndication that's a pretty small one, then I've seen that happen. So the closest thing to a syndication would probably be a DST.
Right. Okay. Any questions, Johnny? You've been kind of quiet over there. No? All right. So
No, that's really, I mean, it's really, really good information. And so it's like, I'm just trying to take it all in. There's a lot going on there.
Oh, yeah, I kind of warned you. I got a lot to say.
So just to finish out here, any key tips that you have for investors out there to have a successful 1031 exchange?
Yeah, well, as far as I'm always open, like I'm always welcoming. Just call me, text me if you have any questions, first of all. But the same taxpayer that sells is the same taxpayer that buys. I do want to bring up that. So Johnny sells, Johnny buys. Vang LLC sells or partnership sells, the partnership buys. The same taxpayer. Um, so there's some people will ask me, hey Cindy, I own my property under my name, but can I buy it under another LLC? So there's a difference. The LLC, for me, my question to you is it a disregarded LLC or a regarded LLC? So the difference, a disregarded LLC is a sole member entity. It's not an S corp. It's not taxed as a partnership. It's a disregard. It's disregard to you personally for tax reasons. So you file taxes for your LLC through your personal taxes. So it's on your personal tax on a schedule, like the Schedule C, D, E. Essentially, you're still the taxpayer. Okay, so now I can sell my property under Cindy Pham. I'm going to buy the new property under my disregarded LLC. And then I sell that property, and then I buy another property under a different LLC that I created. And then maybe I want to put it into my next one. I want to put it into my revocable trust. A revocable trust revokes back to me individually, so the taxpayer is still me. At the top of the pyramid, I'm still the taxpayer. All right. Now, if it's a partnership, let's say Vang and Pham partnership, LLC, we own a property together. Well, the partnership sells, the partnership buys. But let's say we go our separate ways.
Mm-hmm.
Laura goes, hey, Cindy, we've owned this property for 5 years. It's time to sell, and we don't want to be your partner more. You talk too much. We want to be your partner, so we want to go our separate ways. So can we do a 1031 exchange? So here we go. Now I own a third of this partnership. You own a third of this partnership. Johnny owns a third of this partnership. So we own an interest in a partnership, which is considered personal property. It's not real property.
Mm-hmm.
Right? So in order to structure this 1031 exchange, there's a process called a drop and swap where you dissolve this partnership. All right? You dissolve this partnership, you distribute the ownership into individuals as a tenant in common. So it's going to be redeeded. Now, Laura, Johnny, and Cindy is going to own this property, and then we're going to take our respective thirds in 1031 exchange. So there's a process to do it.
Okay. All right. So where can people reach out to you?
They can shoot me an email at cindy@legal1031.com. And they can also give me a call at 713-591-0067.
All right. We'll put that in the show notes as well. So if somebody's watching this later, we'll have that information for you. So we're going to end the show. We always end the show with some rapid fire questions for our guests here. Are you ready?
Yeah.
All right. So what's your one ninja skill that you're absolutely really good at?
What repeat that again? What am I good at?
What's your one ninja skill, right? Like that you've honed, right? What would you say that you're just super awesome at that,
Oh, well, I think running. No, not really running, but dodging.
Okay. That's an interesting one. Okay. All right. Next question here. How do you keep your skills sharp?
How do I keep my skills sharp?
Yeah, in the game and what you do.
One, I actually remember the things that I listen to, and a lot of times, and by doing this for 7 years, I mean, it's just one tax code, and I've just starting to enjoy what I do. I'm probably one person that speaks about tax on a capital gain side, but probably the most animated person that you're probably gonna ever see are me. But I do truly enjoy what I do, right? So, and then I have interest in the clients. I love deal making, so it exercises my brains, and so it keeps me sharp by just speaking to clients, and just I love to dissect into their deals. And technically, I'm not supposed to give advice, but I always want to know what's going on, what are you doing, like how are you structuring this, but I like to get into, I like to stay sharp by understanding what other clients are doing. And sometimes I don't give advice, but I'll tell, I've got clients that do this, you might want to talk to your advisor about this and that.
Got it. Okay. What's one book that has either transformed your mindset or your business?
Books. I don't. I'm starting to read this right now. Tax Smart. This just came out recently. Not that I'm doing my plug, but I was actually a contributing author here. Tax Smart. So I'm actually reading through the other chapters right now. But a lot of my other stuff I do on a leisure level.
Okay. So you're from Houston. If we're ever in the area, what's the one place we gotta eat?
One place, okay, Tex-Mex.
Tex-Mex.
Barbecue.
Is there a specific restaurant?
Tex-Mex El Tiempo.
Okay.
El Tiempo is my go. I always bring my clients from out of town. Also, we have, Houston is a melting pot. We have, it's a very diverse city, so we have good food in every ethnicity. So a lot, the Asian food here, the Vietnamese food. I'm Vietnamese, the Vietnamese food, the Chinese food, even the Korean food. Like we have such. If you want Asian food is good. But a lot of times the Tex-Mex, because we're in Texas, the barbecue. There's Truth Barbecue. There's a lot of different barbecues. There's Killing Barbecue. There's you've been to Houston, right? Have you had the barbecue over here?
Yes, I've been to Killins. Yes, I've been to Killins. It's really good.
Yeah.
I think there's one called Corkscrew in Spring, right?
Mm-hmm. Yeah.
But Vietnamese, what's the top Vietnamese restaurant for you that we got to try out?
So there's a lot of Vietnamese restaurants that are good. I like Dak Cao, Dakao.
Oh, I've been there.
Yeah. So that's actually a restaurant that has a lot of, everything is good, I think. But there's a lot of restaurants that have there's specific things that I want. If it's a pho or bum away, there's different places that I go. If you want a generalized, try a sampling of everything. If you like a buffet style, the Kim Sun buffet has a good option of street food, Asian food, noodles, and all that. It gets really busy. Yeah.
Awesome.
Super cool.
All right.
Johnny,
close us out.
Yeah. So that concludes our episode 6 here, going over a 1031 exchange. We were so excited to have Cindy, and Cindy, thank you so much for joining us here on our podcast. And we look forward to getting more information from you. We may have you back on in future podcast episodes, and so you guys got all her contact information already. If you guys liked this or found it valuable, please subscribe, share with all of your friends, and then join us on Sundays at 7 p.m. As we go over more ninja level strategies, right? Next week, we'll be coming to you guys from EXPCon in Miami. Both Laura and I are with EXP, so we're going to be out there at EXPCon meeting some of the top producing agents. And so stay tuned for that. And as always, keep sharpening your ninja skills, stacking your wealth, and making those ninja moves. All right.
Dodge your taxes. Dodge your 1031 exchange taxes, your capital gain taxes.
Right. All right. Thanks so much, Cindy.
Thank you so much. Bye-bye.
Bye.